The information and opinions expressed in this show should be considered as entertainment and for educational purposes only. We're here to inform, enlighten, and make you laugh, but we're not giving financial advice. Any information in this episode should not be relied upon while making investment decisions. If you're looking for financial advice, please consult with a professional financial advisor. The hosts and guests may or may not hold positions in the securities we discuss.
Today, we are honored to welcome Gautam Baid to the Stock Up podcast. He's the author of The Joys of Compounding and founder of Stellar Wealth Partners India Fund. In 2018 and 2019, he was profiled in Morningstar's Learn from the Masters series. Gautam's insights on investing, learning, and the power of compounding have inspired countless investors around the world. It's a real pleasure to have him on the show. Welcome, Gautam.
Thank you for having me. Looking forward to this.
We are really looking forward to having you with us for the next hour. And I just have to start with this question. You've described compounding as the most powerful force in the universe, beyond just finance. So how did you come to this realization, and how does it shape your daily decisions?
So that's a very good question. So actually, I came to this realization after achieving financial independence. And if you have read The Joys of Compounding, you would have seen that basically achieved financial independence in the year 2018. And this particular event was the result of compounding in various aspects of my life. So it was not just compounding money or capital. It was the result of compounding in various aspects. You do not achieve financial independence just by focusing on investing. You have to compound in multiple areas in life, and you get what you compound for on a daily basis. So for example, compounding positive thoughts, compounding good health, compounding good habits, compounding wealth, compounding knowledge, and compounding goodwill. You have to compound in all these 6 areas. Then, as a result, you basically achieve true success in life. Because success, in my view, is not just about making a lot of money. You have to compound in various aspects. For instance, compounding positive thoughts. You have to avoid negative thoughts coming into your brain. You have to avoid negative emotions because they affect your disposition. You have to inhale blessings, exhale gratitude. Gratitude is one of the most effective ways to find contentment. And you have to celebrate these small wins because these create positive momentum in your mind to achieve long-term success. So that's some of the things you can do to compound positive thoughts. How do you compound good health? One of the best health habits is to exercise for an hour, 3 to 4 times a week. Another good habit is to drink lots of water and consume less sugar and less junk food. And the third good habit is to get at least 7 to 8 hours of sleep every day. Now, the fundamentals are not, very fascinating or intriguing, but they just work. And that is what you have to basically compound on. You just have to focus on the fundamentals, the basics, the first principles, and continue for a long period of time. Similarly, compounding good habits. So basically, like just to paraphrase James Clear, who wrote The Atomic Habits, your outcomes are a lagging measure of your habits. So your energy levels are a lagging measure of your sleep habits. Your net worth is a lagging measure of your financial habits. Your knowledge is a lagging measure of your reading habits. Similarly, your fitness is a lagging measure of your exercise habits. So again, it's all about dogged incremental progress for a long period of time. You basically just have to stay at it. Just once you have faced the right direction, all that you need to do is keep on moving. Now let's also talk about compounding wealth. In the joys of compounding, there's a mathematical equation which I've written for successfully compounding wealth. First is you First is addition. You add to your savings every month. Second is subtraction. Eliminate greed, biases, and short-term thinking and wasteful expenses. Third, multiplication. You multiply your time horizon. Fourth, division. Divide across asset classes as appropriate for your personal circumstances and stage in life. And finally, achieve the exponential power of compounding. Now let's also talk about compounding knowledge. It really pays to build up a large mental database of businesses and industries because over time you start developing pattern recognition, and successful investing is nothing but developing all these investment frameworks in your mind, what we call pattern recognition. Because then you can apply one of these tools from your investing arsenal in any kind of market to generate alpha for yourself and your clients. And finally, we have got compounding goodwill. There's a very good talk on YouTube about of Guy Spare and Monish Pabra at Google. In that particular talk, Guy Spare talked about the importance of being a giver rather than a taker. In fact, there's a great book by Adam Grant called Give and Take. Definitely read that book. It's basically shows you the power of compounding goodwill when you help others unconditionally without expecting anything in return. And if you just do this on a daily basis, just be a helpful and kind person, that itself becomes a huge competitive advantage in the in any profession, especially in the value investing profession. Because then what will happen over time is you'll attract like-minded in people into your fold, into your circle. People will start sharing great investment ideas with you unconditionally. They'll also try to help you out as well, and a virtuous cycle basically falls in place. So this is why I tell people that compounding is the most powerful force in the universe across various aspects in our life.
Yeah, that's some good points. We were lucky to have Guy Spear on our podcast earlier this year, and it was quite fascinating talk we had with him. And he is truly a giver and a good hearted man, is my experience. And I think Albert Einstein coined the phrase "compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it."
Right. So true.
So. Yeah, I think I think so too. So, um, what kind of relationship do you have with the word compounding in your life? What's the most important thing for you to compound, since you clearly are financially independable?
I think basically once you have made it in terms of wealth, then you try to give back to the investment community. That's why in fact the first edition of Joys of Compounding was self-published by me and sold for zero royalty. I did not earn any income from the first edition because I was just trying to give back to the investing community from whom I've learned so much over the years. So I think it's a natural transition for people basically who have become wealthy, that they then start the second half of their life is devoted to helping others and giving back to society. So that's basically the path that I'm following right now. Compounding goodwill.
Yeah, that's kind of um, a good thing, because I believe in karma. Do you give something to people without expecting something in return? Uh, in one way or another, you will get some positive feedback as well. It's kind of like a loop, and it's like that with investing. If you don't invest financially, you will never compound your wealth either. So it's kind of just getting started to learn and grow as a human being as well as an investor. So I wanted to talk a little about your journey from investment banking in Asia to founding a Buffett-style partnership, which is fascinating. What was the pivotal moment that shifted your approach from short-term trading to long-term value investing?
So again, a very good question. So most value investors, I basically got to discover this particular field by coming across the teachings and texts of Benjamin Graham, Buffett, and Munger. So I entered the Indian markets in late 2007, and for the first 6 years, I basically spent a lot of time doing short-term trading, futures and options, positional trading, swing trading, and just lost a lot of money. And it was only when I came across Benjamin Graham's teachings in 2013 through the Intelligent Investor that I started focusing on deep value plays. And in my book, The Joys of Compounding, I've written about this, that prior to December 2013, I used to invest very small amounts in the Indian market. But in December 2013, for the first time, I invested a decent sum of capital. And because I was heavily influenced by the teachings of Benjamin Graham early in my journey, like most investors, I used to focus more on deep value and mean reversion plays. Basically, I used to invest in illiquid micro caps, deep cyclicals, commodity stocks, and I was very lucky that I achieved financial independence and made a lot of money in the next 4 years. So in India, we had a 4 year bull market from December 2013 to December 2017, primarily in these three areas. And in what happens is that when stock prices are going up and your portfolio is going up rapidly, then you start thinking of yourself as a very astute investor. But it's merely a rising tide lifting all boats. It was only in hindsight that I realized that I was investing the wrong way until December 2017, because I was just looking for statistically cheap securities. That is what Benjamin Graham teaches us, right? Just focus on companies which are selling for less than book value, less than their working capital amount on the balance sheet. But I was not focusing on the quality of the business and quality of the management. And that's why in my second book, The Making of a Value Investor, I've written that our personal experiences in the market over time eventually lead us to our individual investing styles. The bear market in India from January 2018 to March 2020 ingrained in my mind the significance of resilience and longevity, which are the key to compounding. And that long bear market brought about a profound shift in my thought process as an investor. Earlier, I used to focus more on shorter term mean reversion plays, commodities, cyclicals, micro caps. But henceforth, after the bear market got over, from there on, I started focusing on return of capital before return on capital. Capital preservation and more importantly, a focus on quality would take precedence for me henceforth. Because when you're investing in statistically cheap securities of mediocre or bad quality businesses, then during an industry upcycle or during a market upcycle, you will make a lot of paper profit. But once the going gets tough and economic conditions worsen, then those businesses start incurring losses and you end up with permanent loss of capital. But if you invest in a very high quality, strong business, which is enjoying sectoral leadership, then those managements tend to capture market share from their weakened competition during bear markets and tough economic conditions. And this market share capture is a source of great value creation for shareholders over time. So, this was a big learning for me from that bear market, that you can make temporary paper profits by investing in a poor quality business during a bull market, but sustainable long term wealth is made only by investing in quality businesses with healthy growth and which have got durability and predictability of the growth. So, in your questions, you used the phrase long term value investing. That is why my second book is titled The Making of a Value Investor, because value investing is not the same as valuation investing. True long term investing, you have to focus on the quality of the business and quality of the management. So basically, this is how my approach has shifted over the years, from initial the years of short term trading to a shorter term mean reversion plays as a deep value investor, and finally becoming a quality focused investor and who thinks long term.
I think that's very interesting, and I don't remember fully the story, but everybody talks about Buffett always getting to buy stuff on the cheap and then quality business on cheap. But he bought Coca-Cola like a century ago. But when he bought it pretty expensive. But it was a very long-term value play, right? So I think that's a very good distinction about valuation investing and long-term value investing. That's two very, very different things, to be fair.
Because again, keep things very simple. Think in terms of first principles. The intrinsic value or present value of a stock is the discounted present value of the future cash flows. So the longer the duration of cash flows of a business, the more higher the current intrinsic value. But when you talk about valuation investing, then you're basically talking about deep cyclicals, commodities, short-term mean reversion plays. Then you have to keep on recycling ideas all the time in your portfolio. You have to keep replacing the fairly valued stock with another new deep value stock, and you end up incurring capital gains taxes. It's but building unrealized gains in a security is one of the best tax-free ways to create long-term wealth. And this is something again which you get to learn only after your portfolio attains a certain size, that you you want to minimize churn and you want to compound tax-free gains for a long period of time.
That's a really, really important point. So you talked about, you emphasized that the behavioral edge trumps analytical edge in investing. Can you share a personal example where mastering your emotions made a difference between success and failure?
So the best example of this would be March 2020. So in just one single month of March 2020, the Indian markets collapsed 30%. Small cap, mid cap index also fell 30-35% each. Individual stocks fell almost 50%. But I did not sell even a single share from my portfolio of quality stocks in panic. And thus I was able to eventually recover later on. So this is one of the biggest examples where I kept my emotions in check, did not panic, and just by doing nothing, I was able to eventually recover back and make an all-time high in my portfolio by November of the same year. So from the lows of March 2020, I was already back to all-time highs by November of 2020. But if I had sold all my quality stocks in panic, then I would have never been able to remain in the game and eventually recover all my losses. So this is definitely an instance where I benefited from just remaining calm and not losing my cool.
Yeah, that's a great example because obviously when stuff just falls like a waterfall and you're down 30-40%, and if you sell, then you're like you're hurt, right? And then it's really difficult to buy them back when it turns. So it's a really it could be quite a trap. So
And
that's
you
very
get,
very
and you're never able to buy those stocks back at the level at which you sold them, or below the level at which you sold them.
yeah,
Or
exactly.
the stocks come back to your sale price and they never come back to your sale price. They go way higher because of anchoring. Because of anchoring bias, you are never able to get back in.
Yeah, that's so true. That's so true.
So, uh, uh, how do you identify businesses with durable moats versus value traps that appear cheap but erode over time? Because there is many. I'm paraphrasing people saying, "Oh, this quality stock is cheap. It traded at 30 times earnings the last decade, but now it's 15 times earnings," and people buy into that story, hoping for a multiple expansion, but it never happens.
Very true. So basically, let me talk about value traps first. This is a very important subject. So value traps are businesses that look cheap, but actually are very expensive because the underlying earnings is in disarray. And this could happen for a variety of reasons. For example, number one, cyclicality of earnings. A low price to earnings stock, a low P stock, may look optically cheap because the business is enjoying cyclically peak earnings at peak operating margins, but the normalized price to earning multiple may not really be low when you adjust for the cyclicality of earnings. Number two, app risk or technology risk. For instance, a taxi company may look cheap based on past earning power, but those earnings may have existed only until Uber and Lyft arrived on the scene. Number three, bad capital allocation by the management. The market may correctly be punishing a business by assigning a low multiple to its earnings because the owners keep burning cash in below the cost of capital, and there is no prospect of such capital misallocation being stopped. Governance issues. A business run by a crook may appear to be quite cheap relative to the large amount of cash reported on its books until that cash is completely siphoned off. So this gives zero valuation to the cash held in the books of a business which is owned by shady owners or which is being run for social purposes. And Thomas Phelps, who had written a great book, 100 to 1 in the stock market, he had said very wisely that remember that a man who will steal for you will eventually steal from you. So avoid partnering with such forms of management. So that's about value traps. Now, how do you identify businesses with durable moats? Strong brands with share of mind, which confer pricing power, businesses which have network effects, high switching costs, a collection of opposed to relying on just one or two patents, businesses having favorable access to a strategic raw material resource or proprietary technology, and government regulation which prevents easy entry for new competition. All of these can confer a strong competitive advantage, what we call moats. And that those moats in turn enable excess returns on invested capital over the cost of capital for long periods of time. And this is basically how you identify businesses with durable moats and avoid value traps in the market.
So do you have any good examples, right, as we speak?
So there are so many examples. For example, if particular raw material supplier, like I'll just give an example from the Indian markets. That's easy. There's an example of network effects, for example. So there is a commodity exchange called Multi Commodity Exchange, which has more than 95% market share in commodities trading in India, in futures and options trading. That exchange has got more than 95% of the trading volumes in India. Now, when you're looking to hedge your commodity exposure, or when you're trying to trade in commodities, you would obviously try to look for a exchange which with the maximum amount of trading liquidity, because you don't want to incur impact cost on the way in and on the way out. So you want to only transact on an exchange which has got maximum liquidity. That's why this kind of business has enjoys network effects. The more the market participants join this exchange, the more liquid the exchange becomes, and as a result, the more market participants further join this particular exchange to transact. So that's a good example of network effect. And similarly, for all these, different modes, you have got examples in every kind of market.
Yeah, exactly. So I think that like you touched in on it in the when comparing value traps with quality businesses. So because like the participants, like they're pretty good at valuing the underlying businesses. Like usually most of the time when something sells cheap, it's for a very good reason, right? So how do you sort out the quality, the diamonds in the stone pile? What characteristics do you like to see?
So basically, growing firms with high return on invested capital and opportunities for reinvestment at those high ROCs, return on invested capital, they're basically more valuable in terms of net present value. And you have to, be very adept of the latest consumer trends, the latest technology trends, because like I mentioned, there are four ways: cyclicality of earnings, technology risk, the bad capital allocation, and the corporate governance issues. So if any of these four points are present and the stock is available cheap, then you know that the market in its wisdom is correctly giving a low P multiple to that particular business. So basically, once you have, so just use the process of elimination. Once you've eliminated the bad, what remains is, average or good. And then again, you further refine and your process, and you try to eliminate the average and only focus on the good. So it's a step-by-step process. First of all, in the market, see, calling a business of good quality is very subjective. But we definitely know for sure what is a bad quality business or a bad stock to invest in. That is very, much more obvious. So try to first just focus on elimination investing. Focus on eliminating the bad first. You automatically will arrive at a more sensible investment universe to pick stocks from.
So, how do you balance the tension between concentration for conviction in these kind of stocks and diversification for survival? What does your ideal portfolio structure look like, Gautam?
So I size individual allocations in my portfolio according to my evaluation of potential risk, with the largest holdings having lowest possible risk of capital, with the largest holdings having the lowest likelihood of permanent loss of capital, coupled with above average return potential. I initiate new positions with an initial weight of 3 to 5% at cost, and then I subsequently average upwards if the management executes above my expectations. And individual position sizing is important not only for its impact on overall portfolio performance, but also for one's mental peace of mind. I sell down to my sleeping point if a single position becomes a discomfortingly large percentage of my portfolio by value. And one should have bigger weights. This is with longevity, solid growth prospects, and disciplined capital allocators. As May West very rightly said, too much of a good thing can be wonderful. So that is the philosophy I follow when constructing my fund portfolio.
Do you look at sectors, for instance, or do you just look at uh, stocks as a single participant in your portfolio, just to try to emphasize the importance of diversification?
Yeah, that's a good point. So, I do follow a policy of prudent diversification. At any point of time, I hold between 20 to 25 stocks, diversified across industries and risk factors. Individual stock level exposure limits in my fund are capped at 15%, 15% of AUM. and individual industry level exposure limits are capped at 30% of the AUM to avoid single factor risk. So risk management is both at the individual stock level it is done, and it is also done at the individual industry level.
So how do you distinguish between respecting the overall market wisdom and getting swept up in speculation, as we have seen in the AI trade and the ESG narrative in 2021?
Over time, as a active and highly engaged investor, you start developing what is known as a feel for the market. So if a group of stocks from a single industry are all rapidly going up together for the first time, if this is happening for the first time after a long time, then that is a strong signal that the fortunes of that industry may be turning around and should be investigated further. This scenario is even more significant if it happens amid overly negative sentiment for the sector in question. And this is one of the best ways to identify inflection points in a sectoral trend that occur just as an industry's fortunes are beginning to turn around. Most of the time, you will observe that these stocks that are going up rapidly together, they do not have any current earnings to support their valuations. But we generally realize only in hindsight that the market was an extremely smart discounting machine. For instance, in 2022, the Nasdaq crashed 40%, within which Nvidia fell 68%, Apple, Google, Meta, Amazon all fell 40% each. So all of them, were basically absolutely bombed out. But then in November 2022, you had the introduction of Chat GPT, and suddenly you noticed that these mega cap tech stocks started going up rapidly together at the same time for a few successive days in a row, and after that for a few successive weeks in a row, and then for a few successive months in a row. And if you had been able to avoid anchoring bias, you would have been able to understand that this is how you're basically identifying an inflection point in the US tech sector, and you would have been able to get in at reasonable valuations. So this is a good way to identify inflection points in a sectoral trend, and you're able to avoid speculation because you're buying stocks when they're most hated or when they're completely neglected. So therefore, you don't get swept up in speculation. Speculation is when these stocks have been going up for a long period of time and are trading at very high earnings multiples, and that is when the danger is the highest. That, for example, we have had more than a 3 year long bull technologies. Large amount of the gains have already occurred, and from here on, you have to be very careful.
So do you buy into the Magnificent Seven narrative? Do you really think they will pull off the growth expected from the market? Because they are delivering stellar performance, both fundamentally and obviously with the return on investment for retail investors and institutional investors.
Very good question. So, see, one very important point I want to highlight here is that 3 years ago, the Max 7 were basically very capital light, especially all the software tech companies. They were very capital light companies. But now you have got a situation where these Magnificent Seven are expected to spend almost $500 billion from their free cash flow on capex or building all these data centers, their infrastructure. So, if the capital intensity profile of the business is changing so rapidly, you better be 100% sure that these productivity gains which they're promising, and that the fact that they will be able to eventually monetize it does occur in the future. Because if it does not happen, if you look at the recent MIT study which mentioned that 95% of AI projects have not delivered any value or any cost savings, if such a big in the future, when these guys are about to try to monetize through AI application layer, then you may see a big fall in those stock prices. But right, in a bull market, stocks run on narrative and hope of a great future. So let's hope for everyone's sake that the great future materializes, because today the US, while having 4% of the world's population and 25% of the world GDP, is having 70% of global market cap, which means that more than two out of every $3 invested in the world has been invested in the US market. And even within the US market, the top 10 stocks are having 42% weight in the S&P 500. It has never happened. So huge concentration risk is there. So let's hope for the sake of global markets that these dreams which are being sold do fructify in the future.
Yeah. I mean, what could possibly go wrong, right? So it's not like we had a dot-com bubble burst some time back. If we could go over to like your daily routine and stuff like that, you've said that you that a lifelong learning is the ultimate investment. Sorry. What's your daily reading routine like?
Oh, there are so many. This is one of my favorite part of my work every day. So so I go through all the corporate announcements on the Bombay Stock Exchange website. That is where all the listed company in India upload their corporate announcements. I go through press releases, investor presentations, M&A deal, joint venture partnership agreements. I'm also going through the quarterly conference call transcripts on platforms like Trendline, Alpha Street, Research Bytes. Even the company website investor relations section provides this conference call transcripts. I go through the interviews of managements of businesses that I'm tracking. I go through screening tools like Tejori Finance and Screener.in. They are the two most popular screening tools used in India. I also read equity research reports by brokerage houses in India whose quality of content is pretty good. I read brokerage reports from Ambit, ICICI Securities, Spark Capital, India Infoline, Nirmal Bank, and Axis Capital. For deep dive on individual businesses, I also read annual reports and credit rating reports. And to get a good understanding of the underlying industry, I go through the IPO prospectus as well as the follow on offering prospectus as well. I also read investor letters written by fund managers in India whose investment philosophy I admire and respect. They include Solidarity, Sage One, and Equirus. I also attend all the webinars by School of Intrinsic Compounding in India. I also go through bulk deals, block deals, insider bank data on a daily basis. For magazines, I read Forbes India, Fortune India, and Outlook Business. And for newspapers, I read the Economic Times and Mint Times every day. I also read industry specific websites every day. So for commodities, I go through Platts.com. For steel industry, I go through bigmint.com. For healthcare stocks, I go through contractpharma.com. And for chemicals industry, I go through Chemical Weekly. I also, go through social media platforms like Twitter, now known as X, and WhatsApp group, investing groups, channels, and Telegram channels, and online forums like Value Picker. So there's a lot of reading which happens on a daily basis. This is the most enjoyable part of my job because, hunting for new ideas is an activity which never gets old for a truly passionate investor. And once even after so many years in the market, almost 2 decades, even today, the high which we get when we discover a very exciting investment opportunity, I'm sure you can relate to this, that we feel so excited that, yes, we have found this amazing investment opportunity. So it is like an intellectual treasure hunt where we are looking to strike gold at any point of time. And that is what basically keeps us going. This deep passion for investment research and the investing profession, this is essential because see, the markets will keep going up and down. They'll be volatile all the time, and during bear markets and tough markets, it's very easy to get disheartened. But if you have that underlying passion for the mental process of investing, for the intellectual delight which comes from investing, then that is the key to sustain in this field for a very very long period of time.
Fantastic. So that's quite the reading list. That's very impressive. So I was just curious. So how big is your investable universe? Like how many stocks are or equities are on your watch list that you keep tabs on?
So given the size of the fund right now, see, we do when you're running a public fund, when you're managing public money, then along with the quality of the stocks that you're investing in, you also have to focus on the trading volume liquidity. You cannot invest in highly illiquid stocks because then exit becomes very difficult when if any investor wants to redeem. So you also, so when you apply the quality with growth filter and you also apply the trading volume or trading liquidity filter, then the investable universe in India just peters down to just 150 to 200 stocks from a universe of 4,000 stocks. So and that is a much more manageable number. This 150 to 200 names is a more manageable number to basically keep track on. And the beauty of the Indian markets is that most of the industries in India are cyclical. These cycles, business cycles, industry cycles, last for 2 to 3 years. So because you have your investment universe ready with you, so what happened, because you were invested in those industries in the past, their industry is about to go into down cycle, you exit them. And because you have developed pattern recognition from so many years of investing, you're able to deploy the sale proceeds into the next set of stocks from an industry which is just about to enter into an upcycle. So you buy and rotate, and you have a 2 to 3 year view, and at the end of 2 to 3 years you keep evaluating whether the next 2 to 3 years look good or not. And if they look good, then you hold on. Otherwise, you exit and then move to the next opportunity. So this is why real world experience in this market in which you're operating in is very very valuable. It's like gold, literally speaking.
Charlie Munger's lattice work of mental models has clearly influenced your thinking. Which 2 or 3 models have been most valuable in avoiding costly mistakes?
I'll talk about two behavioral biases, or two mental models here, because and since you talked about mistakes, so our biggest mistakes in investing turn out to be our greatest teachers. And I mentioned that I'd entered the Indian markets in late 2007. I remember I'd invested in a stock called Ispat Steel in January 2008, and I'd invested in a mutual fund called Reliance Power Sector Mutual Fund in December 2007, because both of these investments belong to the hot and fancied sectors of power and steel at the time, and both of them had gone up sharply in a short span of time when I first noticed them. So I blindly extrapolated the recent price trends in them without paying any heed to their valuations or underlying business models, and I eventually paid the price. Both those investments crashed 70 to 80% within the first 12 to 18 months of my purchase, and I'd successfully gained my admission into the stock market by paying my tuition fee. But as long as you take the learning from any mistake, and I'm very grateful for all the valuable experience and wisdom that each loss has given me. In particular, these two losses were caused bias and recency bias. So what is recency bias? Recency bias is our tendency to extrapolate the recent events into infinity as we assume them to be the new normal until it is not normal in a cyclical world. So you have to avoid getting swayed by the recent news flow or the recent developments. Because at the end of the day, most businesses and most of investing is cyclical. You know that is the reality of life. That's the reality of financial markets. That's the reality of different industries. Everything goes through cycles. But if you fall prey to recency bias and start extrapolating, for example, if we start extrapolating the last 3 years big returns in Max 7 stocks for the next 3 years, assuming that things will be rosy forever, then that may be a big error in investing. So you have to look at things with a fresh pair of eyes as they stand today. What is the prospects from today onwards? Don't extrapolate what has happened in the past. Second is vividness bias. Now, vividness bias tends to take place during times of excessive or overblown coverage of a dramatic event in the media. This makes investors experience an adrenaline rush, and they bypass the checklist and end up making rash or hurried decisions, because the vividness of an event or the graphic nature of an event, that acts as an impediment in our logical reasoning because of our tendency to overweigh the importance of a vivid event and to underweigh the more important but not so vivid gradual changes taking place on a daily basis, because we get so swayed by all the negative news flow which is flashed by the media, whose only purpose is to capture eyeballs for generating ad revenue, that we do not even focus on the big picture, that how much good there is and good things that are happening in the world as a whole on a daily basis. How much progress is humanity making on a long term basis, year by year, slowly. But this is why you have to be aware of these biases. The first step to overcoming these biases is to recognize them and to acknowledge their presence. That's very very important.
Do you also think with this day and age with uh, mainstream media, social media as well, that it kind of influences investors in a bad way, because people look for instant gratification, it seems.
Oh, as the speed of information disseminations in the markets and competition for short-term outperformance among money managers increased over the years, patience levels and time horizons have significantly decreased. And today, an investor's edge is less about knowing more than others about a specific stock and more about the mindset willingness, and discipline to hold a long term view of the intrinsic value of a business. So definitely social media and has further exacerbated and aggravated the short term thinking problem. And therefore a long term horizon, patience, they have become the greatest edge for investors today.
So-called the time arbitrage.
Right.
Hmm. So you've emphasized the inversion technique, asking what will make you fail rather than succeed, which is quite important. Can you give us a practical example of how you've applied this in your fund?
Yeah, this is one of the most powerful mental models that I follow. So, to make good investing decisions, you need to actively look for reasons not to buy the stock in question. As Charlie Munger has taught us, invert, always invert. So, for example, I ask a few inverted questions whenever I'm looking at a stock for potential purchase in my fund. And these questions break the mindset of trying to find supportive bullish reasons and force me to actively seek out disconfirming evidence. For instance, I ask myself, what is this stock not worth versus what is this stock going to be worth? Because if you can identify the floor price or cheap price for a stock, it is far easier to make profitable decisions. So let me illustrate this with a real world example. How do you identify the floor price for a stock? So in March 2023, in the Indian market, there was a stock called Aarti Pharma Labs, which was spun off. I'm assuming you guys are familiar with the concept of spin-offs. So in India, we call them demergers, but anyways, I'll use the term spin-off. Aarti Pharma Lab was a spin-off from Aarti Industries in March 2023. Aarti Industries was a mid-cap stock and it was a chemical stock. Okay, it was and it was held by mid-cap funds and chemical dedicated funds. Now, when those mid-cap funds and chemical funds received shares of this small cap pharma company called Aarti Pharma Labs, then the mid-cap fund could not hold the small cap stock, and the chemical fund could not hold the pharma stock in their funds and their portfolios because of their rigid institutional and corporate mandates. So they engaged in forced selling of the stock of Aarti Pharma Lab in the open market. As a result, after listing, the stock of Aarti Pharma Labs collapsed 40-45%, and it was available at a trailing P multiple of just 12 to 13 times trailing earnings per share. Now, there's a corporate group in India called the Aarti Group of Industries, and they have got multiple businesses listed in the Indian stock market, including Aarti Industries, Aarti Drugs, Aarti Surfactants, and now Aarti Pharma Labs. Aarti Pharma Labs, from the same owner group, was trading at a trailing P multiples. Whereas another pharma company from the same group called Aarti Drugs was trading at a trailing P multiple of 25 times. Aarti Drugs is into manufacturing of commoditized bulk pharma products, bulk drugs, which is a low margin business, a commodity business essentially. That was trading at a trailing P multiple of 25 times. On the other hand, because of this forced selling post spin-off, the stock of Aarti Pharma Labs, which was a much more specialized pharma business, a higher margin business, a higher quality business, was trading at a trailing P multiple of half the valuation of Aarti Drugs. How can a much more superior business trade at half the valuation of an inferior business? That did not make any sense at all, right? And it is these asymmetric risk reward opportunities which arise from time to time, once or twice every year in the stock market. This is when you have to take decisive action. I basically made Aarti Pharma Labs the biggest position in Stella Wealth Partners India Fund portfolio in March 2023. And since then, the stock has given a return, unrealized total return, unrealized gains of more than 200% as of date, in just 2.5 years.
Congratulations on the two-bagger.
Thank you.
So, pivoting to India's economy, what structural trends do you make you bullish for the next decade, and how do you navigate any geopolitical noise that often dominates headlines?
Well, I'll answer the second part of your question first, because one of the best ways to navigate all the geopolitical noise that dominates headlines is to construct a portfolio which is primarily consisting of domestic India facing businesses, which derive almost all of the revenue from inside India. That way, you automatically avoid all the export oriented businesses and avoid all the geopolitical noise. For example, the US India trade relations or India's trade relations with any other country, you're automatically able to avoid all that noise. So, as of date, for instance, 82% of my funds investing company revenues comes from within India only. So, by catering to the 1.5 billion strong Indian population. That's one way to create the geopolitical noise. And as regards what long-term trends, structural trends I'm seeing in the Indian market, let me first define what do I mean by long-term structural trends. Long-term structural trends are found in industries with a very favorable structure. They're organized like a monopoly or a duopoly or an oligopoly at best, and they have a long runway for growth. So you have visibility for many years ahead. They're also characterized by consistency and predictability of cash flows. These long-term structural trends are also found in industries which are experiencing value migration. For instance, in the last 30 years in India, we have had value migration from public sector to private sector, from unorganized sector to organized sector, from offline to online. And today there are multiple long-term structural growth plays available in the Indian market, starting with low-cost contract manufacturing, because contract manufacturing at a very reasonable price is in India's DNA across industries. Financialization of savings, branded discretionary consumption, gold financing, that is lending against gold, affordable housing, fintech, music streaming, multiple mega trends are in place. And when you impose a large size of opportunity with a high return on capital for a particular business, which is operating in an industry with a long runway for growth and experiencing tailwinds, you have found a compounding machine. So you want to basically have the bulk of your portfolio in these long-term compounding opportunities.
So you manage a US investor-focused India fund. What is the misconceptions that Western investors have about the Indian markets, and what opportunities are they missing?
Western investors and many global investors, have this misconception about the Indian markets that the markets are very expensive, and as a result, they miss out on many high growth long-term opportunities. But we have to see investing is never black or white. It's always shades of gray. You have to everything. There's a fine nuance. Everything is contextual. So you have to provide context. In the case of Indian markets, free float or publicly available public float is the lowest in India among global stock markets. No other stock market in the world has got such low levels of is no other stock market in the world has got such high levels of insider ownership. As a result, there is a limited supply of equities of quality which is available in the Indian market for purchase. And as a result of this low supply of quality stocks available for purchase, quality with growth in India is available only at an expensive valuation. There are different demand supply dynamics at play, and that's why comparing the valuations of the Western world with that of the public markets in India is not basically relevant. You have to look at each market in context. That in India there are different demand supply dynamics at play, and you have to pay up for quality in a country like India because the supply is pretty limited. You can best expect to buy those quality stocks less expensive in a bear market, but very rarely will you find them cheap. The only way you can get quality businesses at a reason in India is through spin-offs when they experience forced selling, or when there is management change or ownership change of a high quality business which was being run inefficiently by the previous management.
But what kind of sector you said previously that the Indian stock market was mostly cyclicals. What sector within the cyclicals is the biggest one in India?
So within cyclicals, I would say banks, for example, banks is a cyclical industry. Even IT, information technology, has now become cyclical because it's exposed to the vagaries of what happens in the Western world, especially in the US market. So today, banks and IT comprise more than 50% of the headline indices in India, the Nifty and the Sensex, but they are very cyclical in nature. So that, and I always tell my investors that the true growth story of India lies in the broader market outside the index. India is a market for active stock pickers, people who can do bottom up stock picking outside the index, because in the index, most of the companies are either cyclical or they have low single digit earnings per share growth. But why would you want to take risk of investing in a developing country if you're just single digit returns? You want to invest in India for high growth, investors globally invest in India only to gain exposure to high growth companies. Otherwise, what's the point of taking all the various risks like currency risks, political stability risk, geopolitical risk, or governance risks? You have to demand higher returns, and you have to be adequately compensated for the risks that you're underwriting. So you have to aim for high growth mid cap, small cap stocks in the broader market outside the indices when investing in a country like India.
Do you think you will ever try to copy what China has done the last 20 years on trying to bring your own kind of tech industry to the Indian country?
There are already many startups. Yes, yes. There are already many startups in India which are trying to build native applications and homegrown applications. But what I've realized over time is that the network effects of these these US tech companies across the world. You look at what Microsoft has done through their Microsoft Office products. You look at what Facebook has done through Instagram, WhatsApp, and Facebook. The network effects which these companies enjoy across the world is extremely hard to break. So unless you're a country like China, which is basically has got homegrown tech and homegrown alternatives to, for example, China has got their own e-commerce giant Alibaba. They have their own homegrown search giant called Baidu. So unless but replicating what China has done, see, that's only possible when you close off your country to global competition and you do not have free markets. But India, even today, it's a free market, and and it encourages full and fair market competition. So I think it's very difficult for India to replicate what China has done in terms of homegrown tech.
Yeah, that's a good point. So over to kind of market crashes. You've written that the experience of a market crash is totally different from reading about one. Um, what did the bear markets teach you that no book or videos or podcast could teach you?
Number one, humility. That is a trait which no book can teach you. You have to experience a full blown bear market and with a good amount of capital to finally respect the wisdom of the market and to become humble. Because if you are not humble in this profession, then be ready to be eventually humbled, because the market is the ultimate humbling machine. It's only after going through the pain of a bear market that you realize that you should not be arrogant or overconfident as an investor. And second big thing, which the bear market in India from January 2018 to March 2020 taught me, was the importance of investing in quality. We often read about it in books, but in real life, before we have experienced a bear market and lost a lot of money in bad quality businesses, till that time we don't understand the true significance of investing in quality. What happens is, as a bull market matures, most investors move their portfolios of high quality stocks with healthy growth to stocks of inferior quality, inferior management quality, inferior return ratios. Then they further move their portfolios to commodities and cyclicals. Then they further move their portfolios to micro caps with limited track record of operations. Then they further move their portfolios to turnarounds, which are currently loss making. And finally, they move their portfolios to highly leveraged companies with large amounts of debt, but with promise of rapid revenue growth. At this point, the bull market usually tops out. And at the end of the euphoric phase, most investor portfolios have got only junk left in them. During the bear market that follows, both quality and junk stocks fall hard in the beginning. Quality eventually recovers back to all time highs, whereas junk stocks lie low for many years until the next bull run takes over. It's only after going through the pain and experiencing the pain of a couple of such cycles that an investor can finally resist the incessant urge to move down the quality ladder and chase quicker returns. So, this is again something which you learn only after experiencing a market crash or a bear market. Discipline.
How do you stay cool, Gautam? I know a lot of. I've read a lot of books, and I love the book written by Pulak Prasad called "What I Learned About Investing from Darwin," and he emphasized that it's not smart to check your stock market portfolio during bear markets at all. It's the best thing is just to distance yourself from the market and the noise. What is your take?
Very, very wise words. In fact, in my second book, The Making of a Value Investor, in my journal entries from March 2020, I had written the exact same point, that I've stopped looking at my portfolio. I will not look at my portfolio from now on until the market stabilizes, because looking at a big drawdown on a daily basis or a weekly basis will only make me more anxious and make me commit more rash decisions. So I think that's a very, very wise thing to do. Just you know it's anyways unhealthy to look at your portfolio on a daily basis. I, for instance, just check it periodically, but not every day. And especially I do not check it when the market is down in a big way, because this deep rooted loss aversion bias in human beings is what causes a lot of because of these behavioral biases and what triggers them. I just avoid triggering them in the first place.
I have saved up two questions for you, and one is a topic we touched upon initially in the podcast. And in your books, you discuss freedom as the ultimate goal of compounding, which I uh, I think all of our listeners and me and Kenneth as well are eager to achieve, not just wealth. So, financial independence mean to you personally, and how has it changed your life? Looking back to every achievement you have accomplished.
Well, financial independence has definitely changed my life for the better, in the sense that I'm much less anxious now than I used to be before I achieved financial independence, at least as far as the basic needs of life is concerned. So there is no anxiety regarding that anymore. And financial independence to me represents the ability to control your time, being able to do what you want, with whom you want, when you want, for as long as you want. That provides a lasting level of happiness, which no amount of fancy stuff can ever offer. For instance, the short term excitement from having fancy stuff wears off quickly, but having a flexible career or a flexible job with a short commute and flexible working hours, that will never get old. Having sufficient savings, which gives you time and options during an emergency, that will never get old. Being able to retire when you want to, not when you're forced to, that again will never get old. So it's all about getting control over your time and living life on your own terms, because every single dollar that you save is like owning a slice of your future that might otherwise be managed by someone else, whatever his priorities may be. So you have to aim to achieve financial independence at the earliest, to live life as per your inner scorecard.
That's some true life experience wisdom shared right there, people. So, Gautam, my final question will be: looking back over the last 20 years, what advice would you give to younger self about investing, and what mistakes are your most grateful ones that you've made during this path?
I'll answer the second part first, about the mistakes that I'm most grateful for. I mentioned that I'd invested in illiquid micro caps, commodities, and cyclicals, bad quality stocks, and bad quality businesses between December 2013 and December 2017. And I was lucky to have deployed a decent sum of capital just at the beginning of that 4 year long bull market in mid cap, small cap stocks. So that is a mistake which I'm actually very grateful for, because if I made a very significant sum of money in those 4 years, but I was investing the wrong way. Essentially, it was not good quality long term investing, but it was a rising tide which lifted all boats, including mine. So I'm grateful for that mistake. And as far as advice to my younger self, I would definitely advise all young investors and newcomers to in an investment journal. So I bought a journal in late 2014, and I consider that to be one of the best value investments that I've ever made. Since that day, I've been keeping track of my investing decisions and subsequent developments in a journal, which I've also published part of my journal book as well, The Making of a Value Investor. And I've also maintained an archive of the media commentary and investor behavior during various episodes in the last 11 years. I find it very helpful to refer to this information whenever the market undergoes its periodic steep corrections, because human nature in the markets has not really changed much over time. At the same time, referring to my past notes from the journal has helped me learn a lot about myself and improving myself as an investor, because I can notice and observe the common mistakes that I've made. Why did I make them? And see, you know, many investors tend to repeat old mistakes, but the best investors repeat old mistakes or past mistakes less often. It's all about minimizing what you make, and if you can avoid the downside, the upside takes care of itself in investing.
Perfect, Gautam Baid. Thank you so much for being a fantastic guest on our show, and we are truly grateful for your wisdom. This was truly one of the compounder episodes that we have delivered for our listeners. So thank you so much.
Thank you so much. This was fun. Thank you for having me on your show. Thank you.